So audit of banks, 14th chapter, we have two parts. One is bank audit and the other one is NBFC audit. I'll go with complication. What are all the complicated topics are there in this? That I will cover predominantly. Okay. Now, yes, audit of accounts and appointment of auditor. Most banks, especially nationalized banks and PSU banks, appoint 4 or more firms as statutory central auditors as per RBI guidelines. Okay. Appointment letter has to include the following. Okay. Appointment letter includes the following. What are all appointment letter, for what period you were appointed, details of other joint auditors, nothing but other central auditors, details of previous auditors, so that the new auditors can communicate with the previous auditor, procedural requirement for accepting the engagement. So in bank audit, no, the procedure for acceptance is quite comprehensive. That will be a bit detailed, the procedure. They need to give, auditor has to give fidelity certificate, confidentiality certificate, so many certificates and all statutory audit has to give. So what is the process of accepting the appointment and how the work has to be divided among the joint auditor? All these points will be considered in appointment letter. A 3 marks or 4 marks question might come. Okay, so you were appointed as a bank, you were appointed as a statutory auditor for a bank, and you got an appointment letter. Typically, what are the contents of appointment letter will be included? So like that they may ask you. Next, and auditor will give obviously letter of acceptance. Letter of acceptance includes what and all? A confirmation from auditor that he is not disqualified and how the audit will be conducted, declaration of fidelity and secrecy, restriction on taking other assignments from the bank. These are all the points which statutory auditor will give in the acceptance letter. So this both put together, a 5 marks question can come. Next, what is the authority for appointment of branch auditor? Obviously, for all nationalized banks, board of directors will appoint with RBI approval. For remaining banks, annual general meeting shareholders will appoint. For all private sector banks, shareholders will appoint. Nationalized banks, directors directly can appoint where RBI approval is sufficient. Even in other banks also, RBI approval is mandatory. Okay, but the recommendation, the selection, for selection of auditor, RBI approval, then ultimately in AGM members will approve it. Clear? Then conducting an audit, this is completely irrelevant. Here this you have to, this is important again. Okay, risk assessment in a bank, not this, wait, risk management process in a bank will be there. Yeah, this one, this diagram only. Yes, in exam they'll ask you, once it was asked, write about risk management process. By risk management process, this is nothing but 5 components of internal control. This is nothing but 5 components of internal control. Oversight by those charged with governance, identification, measurement and monitoring of risk, control activities, monitoring activities, information system. These are 5 components of internal control. So this is an effective risk management system in a bank. Okay, they'll ask you in exam, write about an effective risk management system. If you write at least headings, you might get 1 or 2 mark. Okay, and you need to write the management, you need to write the matter. For this it is better, I have given a better presentation in chart notes for this. Yeah, you see, understanding this, you see here 5 points. So these one. Okay, so what you need to understand, so board of directors CEO approve a broad risk management policy, and where they need to identify significant risks and they will be measured and monitored. Control activities, directors will implement appropriate control like segregation of duties, accurate reporting, transaction verification, reconciliation controls, limits on cash balances to be held like that, physical security, contingency planning. All these activities they will be implementing, and they will monitor risk management models and all. They'll be monitoring methodologies and all. They'll be regularly assessed and update if any deficiencies identified. And of course this entire controls, everything will be done through information system. So banks need reliable information system for timely and consistent information. This matter, if you write in exam, that will be maximum sufficient. Understood? So that's it. This will be asked for a 4 marks question. They may ask you, every bank should have an effective risk management processes, risk management system. So what are the components of risk management system? Like that they will ask you 5 components: oversight by top management, control activities, risk assessment process, monitoring activities, reliable information systems. These are 5 components of an effective risk management system in a bank. Clear? Next, then yeah, special considerations in the IT environment. Obviously, bank is completely driven by technology. Yes or no? So there is some information that has to be shared with auditor, especially central statutory auditor. A bank, upon appointing central statutory auditor, the bank has to share some crucial information. What information bank has to share? This was even asked in 2021 or 2022 for 4 marks question. Okay, this was asked already. So the bank management has to share with central statutory auditor certain information about IT environment. What? Like bank has to clearly explain overall IT policy and IT structure, what data processing softwares they use, interfaces that they use, data integrity and security policies of the bank, BCP plans and DCP plans. Okay, BCP and DCP plans. The bank has to communicate with auditors. Which auditors? That too, central statutory auditors, principal auditors. And bank must give information about accounting manual, critical accounting entries and their interaction with IT systems, controls over key aspects like account heads, expense booking, all that, controls over internet banking, MIS reports and their periodicity, exception reports and their generation process. This information the central statutory auditors has to be shared. You know, bank has to share to them, to the central statutory auditors. This itself can be asked as a 4 marks question. Then and what are the key control aspects to be verified by stat auditor? This is again itself can be asked as a 4 marks question. This also asked in the previous exam. This was also asked in 21-20 that years, 2022 also, in 2021-22 in those attempts these questions were asked in old scheme. Okay, but the syllabus is same. Now, what are the key security control aspects to be verified by auditor? Auditor has to ensure that data is authorized, accurate and complete. So complete data, authorized data, accurate data is given for processing. System restarts without distorting when there is an interruption. The system prevents unauthorized amendments. Access controls must match staff responsibilities. Segregation of duties must be implemented. Ensure changes in system parameters are authorized. Verify manual changes are properly accounted for and authorized. Exception reports are verified daily. General ledger and subsidiary ledger balances must match. Ensure account master and balances cannot be altered without a proper authorization. Like how a question can come. You are appointed as a statutory central auditor. What are the key control aspects that you need to verify? 4 marks question. The above one is what? The bank has to share certain information which is crucial IT systems related data that has to be shared with auditor. What bank has to share with auditor? This information bank has to share with auditor. Upon appointment, what are the key control aspects that you should verify? This is something that you should verify. Understood? Next. Then finally, now write about internal controls in certain selected areas in case of a bank. Now, general internal controls in banks, commonly what internal controls? There will be a rotation, staff rotation. Independent checks will be there by another officer. Daily proofing will be there for arithmetical accuracy, like checks and all, bank statement, cash ledgers and all. The daily reconciliations will be done. Bank forms will be there, like DDs, checkbooks. They must be stored securely with a responsible officer. Mail must be opened by responsible officer with a signature verification. Any incoming mail, nothing but couriers which a bank receives, yes or no, it must be opened only by a responsible officer, because most of the banks receive confidential information, branches regarding customers. Some customers will send some instructions to the banker that should only be opened by authorized person, generally the branch manager. Okay, signature book and telegraphic code shall be kept with responsible officer. There must be insurance against fire, theft and employee infidelity. Okay, defined financial powers for officers. Surprise inspections of head office and branches by internal audit department. These are some common general internal controls. 4 marks question. They may ask you, write about general controls in a banking entities. What are common internal controls in a banking entity? You can write this answer. Then specifically for cash, there will be controls, like cash will always be in a joint custody of 2 officers. Okay, daily test checking of cash balance will be there. No access to cashiers to the customer ledger. Cashier should not have access to customer ledger. A practical case study is developed on this in MTPs or somewhere. Some practical case studies there. The cashier opened the customer ledger and all. Below MCQ will be there. Which of the above is wrong? Next, cash receipt vouchers. Signing must be by proper officer. Payment shall be made only after voucher has been authorized. High value cash transactions must be verified by higher authority. Excess cash remitted. Excess cash must be remitted to currency chest. Treasury branch will be there. To that, the excess cash has to be. Every branch will have a cash limit. How much cash they can store in the branch? 2 lakhs or 5 lakhs. Beyond that, if the cash is received, at the end of the day, it has to be transferred to treasury branch. Then check clearing. How checks clearing? There are two types of checks: inward check and inward clearing, outward clearing. Best example, if at all the amount, very simple, inward clearing, outward clearing, there's so many definitions, but well accepted simplest definition is what? Inward clearing. If at all the amount is coming into our customer bank account, the amount is coming into our customer bank account, whether it is coming from our own bank account or another bank related customer account, doesn't matter. The amount is coming into our bank books, our customer is being credited with that money, then that is inward clearing. Outward clearing means the amount is going out of our customer bank account. That is called as what? Outward clearing. Now, whether it is inward clearing or outward clearing, generally the checks are processed through something called CTS. This is like a scanner. Okay, so check will be scanned and sent for the clearing house, okay, and they will take care of the rest of the process. Check clearing, check truncation system is implemented for quicker processing. This eliminates physical checks movement, and the branch has to make a call and confirm with the customer for any checks received inward clearing for an amount exceeding 5 lakh and above. Next, verification of signatures on checks. Unpaid checks under outward clearing shall be sent to customer. Next, unpaid checks in outward clearing means what? The check was like dishonored. Okay, all this insufficient balance, whatever. Bills for collection. All documents for bill must be entered in register and sent with the bills. Accounts will be credited only after collection. Then bills purchased. Verify documents of title are assigned to the bank. Bills purchased means obviously what? Bank has already discounted and gave money to the customer. Now the bill is bank right, so title has to be transferred to the bank. Adequate margin is maintained for bills purchase, because bills purchase is a loan given. Yes or no? Bills purchase is nothing but a loan given, so bank will maintain some margin. Immediate recovery steps if at all bills are not collected on due date. Irregular accounts must be reported to head office. Bill purchased and outstanding at year end. For example, I discounted a bill on 20th March, whereas bill maturity date in April month, which means as on 31st March, bill is discounted but outstanding, not because maturity is not yet there, which means the discount has to be apportioned between this financial year and next financial year. Understood? Remember, discount on bill is nothing but an interest. Interest is to be recognized on time basis. It is not based on point of recognition. It is based on time period. Yes or no? That's it. Next, loans and advances. What are common controls over loans? You bank shall make advance only after evaluating credit worthiness of the borrower. All the documents must be executed before disbursement. Correct? Without signing, without Aadhaar authentication, without e-mandate authentication, a bank cannot disburse the fund. Margins must be kept for securities to cover decline in market value. That's why you see there is a drawing power calculation. I think drawing power is also asked in CA final, right? Drawing power calculation is also being asked in CA final. How to calculate drawing power? See, this is mainly popular for working capital loan like cash credit and overdraft. There are two terms: sanction limit and drawing power. There are two terms. One is sanction limit and the other one is called as drawing power. Sanction limit is decided based on repayment capacity of the borrower. Drawing power is decided based upon the value of security given by the borrower. I know you have a capacity to repay 10 crore. I will sanction you 10 crore loan, but you can't withdraw 10 crore loan. Your withdrawal power is decided by drawing power. If I have to let you withdraw, give me security. Customer gave 15 crore worth of stock, 15 crore worth of debtors, and or else let us assume the customer gave 7 crore worth of inventory, okay, hypothecation, and another 8 crore worth of debtors under hypothecation. Both are hypothecated to the bank. So customer gave 15 crore worth of security totally, but as per my bank policy, the stock is subject to market value fluctuations. I have 30% margin. Debtor is subject to insolvency, threat of non-recoverability. I have 50% margin. So 4 crore, and this also let us assume 50 crore for computation purpose. Okay, 3.5 crore, total 7.5 crore. I know the value of debtors and stock assigned to me was 15 crore, but considering decline in margin, non-recoverability risk, all that, I can only give you drawing power 7.5 crore. Understood? So drawing power will be calculated like, look at the stock value, sometimes in exam I'll tell you total stock value is 120 crore, and in this stock, no, some 20 crore is damaged stock, so balance stock will be some 100 crore. Again, there is a creditor outstanding of 50 crore, which means net stock owned by the customer. Net stock owned by the customer. Remember, we will only give loan on own asset. We will not give loan on outstanding oriented assets. Yes or no? Very simple. I have already housing loan. If I want to keep the same house as security, banker will give me a loan only additional amount. He will remove the total loan on the house. Whatever existing loan is that he'll remove, and balance extra how much can be given, that only they'll give. Here also the same logic. So if a customer has 100 crore stock in the godown, out of it 50 crore primary right creditor has on that inventory, yes or no? So remove that, balance 50 crore only own. In this margin has to be applied, 40 or 30 or 50 or whatever margin percentage will be given in the exam. The balance is only drawing power on stock. Are you getting it? Now debtors, 100 crore is there. Sometimes, no, in exam, the most common adjustment is debtors outstanding for more than 90 days. Okay, they will not be considered. In this case, 10 crore is outstanding for more than 90 days. Then 90 crores only your real debtor minus 40% margin. Balance is the drawing power. The debtors drawing power plus stock drawing power, total it. Then total drawing power you will get. Now this drawing power, so this is nothing but this much amount only you can withdraw. And remember, drawing power must be less than or equal to sanction limit. Outstanding amount in a loan account must be less than or equal to drawing power. It must be less than or equal to sanction limit. Clear? Next. And security must be kept in joint custody. Security is nothing but the pledged items, whatever. Securities must be registered in the name of the bank if applicable. Generally this is important. Registration and all will be there for mortgage, immovable property, registered mortgage. And all advances shall be kept within sanction limit and drawing power. Any outstanding balance in advance which is exceeding sanction limit, which is exceeding drawing power, shall be reported. And you know what? If there is an outstanding balance more than drawing power, outstanding balance more than sanction limit, that account is treated as out of order, which is a NPA. Are you clear? An account for an OD account and cash credit account, NPA norm is, if it is out of order, it's an NPA. Out of order means what? Out of order means, this point alone I'll clarify. See, NPA norm. What is NPA norm for loans and advances? Term loans, bills purchased and discounted, OD and cash credit. For both of them, 90 days NPA norm. I hope you know this. If at all there is a overdue for more than 90 days, it is straight away NPA. Whereas for overdraft and cash credit, they become NPA if they are out of order. What do you mean by out of order? Three circumstances out of order will be there. If outstanding amount is more than drawing power, more than sanction limit, then it is treated as out of order. Okay, or suppose outstanding amount is less than drawing power, less than sanction limit, but in the customer ledger there are no repayments for more than 90 days. You know how OD facility works? Customer withdraw money, every month bank will charge interest. Every month they will charge interest, and customer has to pay that interest immediately. For example, for 90 days in the customer account, there are no credits. From bank point of view, debit means I have to receive. Credit means customer repaid. If more than 90 days continuously, if there are no credits in a OD account and cash credit account, then OD account and cash credit account is said to be out of order. Suppose credit is there, but not sufficient to cover the debit. For example, interest we charged 5 lakhs. Customer repaid only 10 lakhs in the 90 days period. Now, which means the customer underpaid the interest. For more than 90 days, there is a due. Yes or no? So, in the customer account, throughout the 90 days, some credits were there, but it is not sufficient to recover the debits. Then, in such a case, that is also treated as out of order. And a cash credit account and overdraft account, which is treated as out of order, is an NPA. The moment it is treated as NPA, it has to be classified as a substandard asset. Okay, fine. We'll come to that later. You're all with me? Yes. Next. Then credit card operations. So effective screening must be there before a bank is giving a credit card. Strict control must be maintained on storage and issuance of card. Once upon a time, all this. Today, credit card is getting manufactured itself after customer make an application. Manufacturing itself is after customer made an application. So, and obviously, merchant verification for available limit. Whenever you swipe, there is a limit check will happen. Then only transaction will be successful. Regular reporting from merchants for settlements accepted by them. At the end of the day, almost all the merchants will put a settlement button. Okay, so that the transactions will be settled. And reimbursement to merchant shall be made only after verification. Like a customer swiped the money with the POS machine, he will get the money on the next day. That money will be credited only after thorough verification. verification whether bank has collected or not. Ensure statement are sent to customers regularly. Monitor overdue payments. If at all any credit card customer used but not paid, stop credit immediately. And if required, to avoid increased losses, periodic review of credit card holders accounts must be done, including limit revisions and provisioning for doubtful debts. This is credit card. This was also asked for 4 marks question. Already it was asked. Okay, I'm telling you, literally every topic in the bank audit chapter is tested, because bank audit chapter is there from past 15 years. When I'm studying also, it is there. Same matter is there. Okay, next, compliance with CRR and SLR. Okay, I'm covering the CRR, SLR also. Okay, 1 minute. Yes, next, computation of SLR and CRR, cash reserve ratio and statutory liquidity ratio. SLR means it's a reserve maintained by the bank in the form of liquid assets like government securities and cash, all that. Cash reserve ratio is a liquidity maintained directly by the bank with RBI. Okay, now how to do the audit of SLR? RBI requires all central statutory auditors to verify SLR compliance on 12 non-Friday dates in each fiscal year. The goal of SLR is to maintain liquid assets to handle sudden increase in depositors request for withdrawal. Okay, so and auditors know they have to give, after verifying SLR, the statutory auditor has to give a report which has to be sent to top management, and the report shall also be forwarded to RBI. What auditor has to report on SLR? Regarding SLR is computed as a percentage of liabilities of the bank. Which liabilities? Customer liabilities. Customer liabilities means what? Demand and time liabilities. Yes or no? A bank will accept deposits from customer, right? These deposits are demand deposits and time deposits. All of us will have savings account, right? That's a demand deposit. Whenever we want, we can withdraw. Time deposit means what? Recurring deposit, fixed deposit. That's it. So as a percentage of demand and time deposit, SLR will be calculated. So in order to compute correct SLR, first DTL has to be correctly computed. So auditor has to give a report on correct computation of DTL. So the auditor has to give a report on correctness of computation of DTL position on 12 non-Friday dates. Then whether the bank is maintaining assets required. Okay, they computed DTL liability correctly, but they didn't invest in any asset, that money. Okay, so both you have to report whether DTL is computed correctly and bank is maintaining the liquid assets as per the SLR requirement. So 2 reports auditor has to give. Next, what is the audit procedure for SLR? First, understand RBI circular on composition of DTL items, because throughout the year DTL SLR percentage may not be same. See, DTL definition is constant. There won't be any change for DTL definition, and this DTL definition is defined long back. Just that in this DTL, liabilities, assets, new items might be included soon. I mean, because every time banks will be launching new products. Okay, so the liability towards customers will be every time new liabilities will be accruing. So DTL definition might be updated frequently. Okay, and moreover, SLR percentage will be changing every quarter, once in 2 months. Whenever RBI do a monetary policy review, they change SLR CRR rates in order and in light of economic scenario, all that. Now, DTL, examine DTL position consolidations prepared by bank, including valuation of securities, all that. Now, these are all the things, some of the items which are excluded from liability. Remember, demand and time liability means customer related liability. Paid up capital and reserves is not a customer related liability. Loans from RBI is not a customer related liability. Bills discounted by the bank is not a customer related liability. Bills discounted by bank is a loan given to customer. Yes or no? Net income tax provision is not a customer related liability. Amount received from DICG is not a customer liability. Amount received from export credit, that corporation, is not a customer liability. Amount received from insurance companies for ad hoc settlement of claims is not a customer liability. These are all not customer liabilities, but these items sometimes appear on the liability side of the balance sheet, but these liabilities are not customer liabilities. So you need not consider any 6 or 7 liabilities. They will ask you a theory question or they can ask you a practical question. Okay, practical question, for that purpose you need to understand all these points. You need to understand all these points. Sometimes examiner will give that. Okay, see, first of all, this is completely automated calculation in bank. Literally today we don't do anything in a bank audit. If at all it's a branch audit, we do bank audit, we do some procedures if at all we are a central statutory auditor. Okay, for a bank branch level, we do literally nothing. We go fill LFAR form and then come back. 5 days work. Yes or no? That's it. Actually, it can be filled in 1 day only, but we drag it for 5 days. Okay, fine. Otherwise, bank manager will be feeling 5 lakhs visa for 5 days, for 1 day. So he'll be feeling bad. Fine. Yes or no? We pretend as if we understood LFAR. Honestly, tell me, literally tough not to understand bank affairs. That too in 5 days. April first week or second week we will go. 4 days or 3 days. Actually 3 days only. But It will be more than 3 days sometimes, very rare cases. If you are ready to stay more than 5 days, bank manager is not ready to hold you. Sir, please finish and go off. Yes or no? Fine, all this. Then inclusion in liabilities. The following must be included in liabilities. Net credit balance in branch adjustment account, because this might be belonging to some customer. Interest accrued on deposits. It's a customer related liability. Cash collateral received under collateralized derivative transaction. Collateral amount received from customer. That's a liability towards customer. Foreign borrowings. Liability to a customer. Reconciliation of notes to accounts, provided the notes to account balance is having outstanding amount. These amounts has to be included in liabilities calculation for DTL computation. In exam, they'll give you these names and numbers. Okay, so and they will give you total liability. In that, these are all included, like that something they'll tell. So you need to reconcile it, you need to add back or you need to less, something you need to do, and then apply the percentage of SLR. That SLR percentage they only give you, you don't have to remember. Next, and the following liabilities are exempted for the purpose of DTL computation: minimum eligible credit and long-term bonds, affordable housing loans, verify incremental FCNR, all that. These are all exempted liabilities for the purpose of all this. Next, and branch data consolidation. Ensure consolidation of data from all branches and even foreign branches to arrive net balances in branch adjustment account. And we do regional consolidation. Verify regional consolidation of branch data with report signed by regional manager, all that. And in SLR compliance report, the auditor shall specify number of unaudited branches and state that reliance on the returns in forming the opinion. See, obviously, State Bank, if you take for example, they have 25,000 branches approximately. 19,000 branches were not audited at all. Okay, even though they were not audited, we are giving opinion on the entire State Bank of India based on the returns submitted by those branches, because they are not significant. RBI has given certain guidelines for exemption on branch audit. The operations are negligible there. The operations are negligible. Approximately 40% of the assets were only owned by 80% of the branches. In State Bank of India, if you take out of 25,000 branches, 19,000, the number appears big, but the number of assets owned by them, the income owned by them is 30 or 40% only, not the major portion. These 6,000 branches collectively control 60% of the revenue of the bank, 60% of the assets of the bank. You can see that in SBI audit report. I would have shown that in this marathon, somewhere I would have shown. Next, so that's regarding SLR verification. Okay, what liabilities will be included, what liabilities will be excluded, exempted liabilities. They'll ask you any of these questions. Okay, they'll ask you what to write about exempted categories for DTL computation. They may ask you a theory question on that. Next, now verification of assets. And you see, first of all, here, what are the assets that are there? Audit of, in the recent exam, in the recent May 25 exam, they asked about asset classification, which is not given in our book. You need to figure out asset classification based on an overview of the concepts. Okay, for example, verification of asset. What assets will be there? Cash and bank balances will be there, investments will be there, and third category of asset is advances will be there. And this is the same order in which Schedule 3 is there. Bank audit Schedule 3, if you see, bank balance sheet Schedule 3, first one cash and bank balances, and then this one investment and and loans and advances. Then we have fixed assets. Within this fixed assets, we have again subcategories. Within this fixed assets will be there, fixed asset premises will be there, fixed assets, other fixed assets will be there, and any other asset is called as other assets. Inside that, in the recent exam, they asked about non-banking assets acquired in satisfaction of claim. What is the asset classification for that? This has to be classified as an other asset. Who will read with the heading? Yes or no? They will read heading, they will read matter, but they won't observe this point that it is a classification. So in the recent exam, they asked about classification of so and so item. Understood? So let's understand that. Yes, verification of assets. So auditor has to verify cash balances, bank balances, money at call and short notice. Okay, the auditor's main objective in cash verification is verify existence and completeness of these items on balance sheet date, and audit procedures has to be tailor-made to meet that objective. Bank implements generally a strong internal controls for cash, like joint custody of cash, periodic checks, and balances with other banks will be reconciled regularly. These are all various controls a bank will implement. The auditor should assess effectiveness of these controls. That's it. Next, detailed audit procedure for cash. Physical verification of cash must be done, as near as practicable to balance sheet date. Now, when you're doing physical verification, foreign currency, ATM, cash deposit, at all the places you must do simultaneously. For ATM machines and all, you can get, automated slips, okay, for physical cash. Then balances with RBI, not that important. Balances with other banks, not that important. Money at call and short notice, okay. Now, verify system of authorization for lending, including compliance with head office guidelines. Money at call and short notice means these are all short-term advances between the banks. Okay, so if I want temporarily some funding, so I have tie up with HDFC Bank, have tie up with IDBI Bank, so that bank will send money whenever I call with just a short notice. Okay, they will give me, and whenever they call back, I will give them back. Verify call loans with borrower certificates and call loan receipts. Check the balances in relevant tally register and match controls. Verify subsequent repayments from borrowing banks. You see here the dealings is with banks. Remember, if I give a loan to customer, that comes under advances head. That comes under advances head. Money at call and short notice is a cash equivalent for a bank. Yes or no? That is not an advances to customer. That's an advance to bank. This is normal operations. Now, ensure call loans are not netted off against loans received. For example, I gave a cash loan to ICICI Bank and I took a cash loan from HDFC Bank. I should not net off and show net liability. I should show call loan given, call loan taken separately under liability and separately under asset. Are you clear? Next, these are all important for MCQs. Verify proper accrual of interest and see that it is accounted on year-end balances correctly. Then investment is not a big deal. It's an easy point, but read. See, just because I'm ignoring, that doesn't mean it's not important. Okay, it's something you can manage on your own. Now, physical verification of investment. This is important. 1 minute. Okay. So, physical verification of investments. So, when you're physically verifying the investment, verify investment scripts at year end. Verify investments which are held with public debt office of RBI, custodians and depositories with statements of holding. Banks will hold investments for the purpose of SLR requirement. These investments will be held some physically in the bank's own demat, or they may be held with PDO offices. PDO office means what? Bank receipt means what? All the time I made a video, scam 1992 Harsha you put. Okay, you'll find a video on the YouTube. You just watch that. You will understand that under scam 1992 what happened. Next, in case of bank receipts, examine counterparty confirmation, get a written explanation for any long outstanding BR. Then BR shall not be issued in respect of government securities where SGL facility is available. So for government securities, bank should not accept GR directly. They should only accept subsidiary general note. I mean SGL note, subsidiary general ledger note. We call it as SGL note. We call it as. Okay. Then valuation of investments. Look at the valuation method and see whether it is appropriate to follow RBI guidelines. Verify correct classification of investments at acquisition based on decisions from board, and ensure that non-performing investments are properly classified and provisioning is made correctly. And examine profit or loss on sale of investments are computed and accounted correctly. And see change in method of valuation of investments. All that. That's it. Enough. Now, classification of advance, most important in the entire bank audit. Classification of advance. Advances will be classified into multiple categories based on nature of advance. It's classified into cash credit, OD, term loan, bills purchased. Based on security, secured advance are covered by guarantee. Like based on place, advances given within India, advances given outside India. Based on sector, advances given for priority sector and others. So advances will be classified in different ways based on this. They can develop a case study scenario like on this and then ask you in a different way. Audit approach. The auditor must focus on obtaining evidence for amount outstanding at balance sheet date, amount due to the bank and their documentation. There should not be unrecorded advances. Valuation and recoverability you should check. Classification and disclosure you should check. Appropriate provision shall be made as per RBI norms for NPS. There is something called IRAC norms, income recognition asset classification. We call it as IRAC, income recognition asset classification. So these norms you need to comply, and you need to evaluate controls over advances. Verify credit appraisal process. So controls over advance means what? I need to look at the control aspects, how the customer screening is done. Okay, so verify credit appraisal procedure including loan application and borrower credit worthiness. Okay, in controls audit I will verify this. In controls over advances, ensure advances are sanctioned by proper authority, means control element I am checking. Ensure documents are executed before dispersal, control element I am checking. Verify compliance with the terms and end use of funds, controls I am checking. check securities existence, enforceability, valuation, including registration requirement, whether security is registered in the name of the bank, is it existing or not, controls checking, ensure compliance with loan policy of the bank. Every loan given by the bank must comply with loan policy of the bank. Then I should also perform substantive procedures. Substantive means what? I will take a loan real account, a loan whatever given to customer, I'll take the account, I will see the ledger movement, I will see how much amount is outstanding, details, test of details, we call it as nothing but substantive procedure. Like what are they? Verify master data in core banking for verifying how much is the installment a customer has to pay, what is the rate of interest we need to charge, what is the loan tenure. These are actual details verification. Yes or no? Here I am not checking loan is given as per the policy. Here customer proofing, customer screening is done properly or not. I'm not talking about any control elements, I'm talking about actual transaction details. Each customer is tagged with a single customer ID across all accounts. Examine all large advances, whereas other advances on a sample basis. What is a large advance? You know, if the advance amount is having more than 10 crore outstanding amount, or if the advance is 10% of the outstanding of 10% of aggregate outstanding balance of the branch. So in a branch, you know, total advances identified as on 31st March. In that 10%, if at all a customer is occupying, he's a large advance. That's a large advance. Or if it is 10 crore, whichever is lower. Okay, whichever is lower, yeah, you can take whichever is lower, getting it. So if at all a customer account is having 10%, if a single customer is having 10% of the total branch loans, then he's a large advance. Or if he's having more than 10 crore outstanding, that's a large advance. All large advances verify 100%, remaining advances verify on a sample basis. And review problem accounts, SMA, SMA2, you know, special mention account 1, special mention account 2. What are they? You know, once you cross due date for payment, after 90 days we classify it as NPA, but after 30 days it is classified as SMA1, after 60 days it is classified as SMA2. The moment it turns into SMA, bank will be following you up, because becoming NPA not only problem for the customer but also problem for the bank. Next, and restructured accounts, you know, verify restructured accounts and RBI compliance for additional provisioning, and examine accounts that are adversely commented by concurrent auditors. Review accounts slipped into NPA within 12 months of the sanction. These accounts are called as quick mortality accounts, which are very dangerous for bank managers for getting promotions, all that. So once a loan is given, within 12 months customer defaulted, so that's called as quick mortality account. Okay, so verify all this, verify completeness and accuracy of interest charged, carry out analytical procedure. These are all substantive procedures, correct? Apart from substantive, now check recoverability point of view. Okay, open borrower ledger account, see whether terms and conditions are compliant. Verify latest statements of the borrower. Why am I verifying statements of the borrower? I want to know whether he will be paying me back or not. I will review security inspection reports. So borrower security is given, right? Our inspection team or internal audit team or valuation team will be inspecting those securities, and they will give valuation reports. That value report I will verify to know whether customer recoverability is, you know, is there any problem on recoverability. Check auditor's report for borrowers with credit facilities for multiple banks above a specified limit, you know, fixed by RBI. This is what ASM reports. ASM reports or stock audit reports, whatever. And you know, in the recent May 25 exam, how the question was asked, you know, like so and so team members are planned for bank audit. Okay, the team members planned, Mr. P is planning to do some 2 procedures, you know, Mr. B is planning to do some 2 procedures, Mr. C is planning to do some 2 procedures. Okay, now question is actually drafted like this: which of the following comes under substantive procedures? Out of the above 6, some 7 or 8 procedures they identified, they gave a list, which will come under substantive procedure, that they asked. Even the question is not straight asked like this, R want to perform so and so, yes or no. You need to sync that. You know, there they have given 3 persons. One want to verify controls, one want to verify substantive, one want to verify recoverability. Below, R is planning to verify the R is planning to perform these procedures. Whether is R correct? Like that they asked a question. No, which means if a student who only remember these points but did not remember this classification cannot write that answer. Understood? I showed that question in the YouTube also. I just uploaded that question. So complicated that is. Next, verification of asset classification, income recognition. As per prudential norms, auditor has to ensure that advances are classified based on RBI norms. How advances are classified? Standard asset, and NPA. NPAs are classified into substandard, doubtful asset and loss asset. This is the prudential norm classification requirement. Now, income is recognized only based on recovery, actually recovered. See, general income is recognized on accrual basis, but once an advance slipped into NPA, income is recognized on cash basis only. Proper provisions must be made for doubtful recoverability. Auditor must familiarize with the latest RBI circular on provisioning and review subsequent circulars before the audit report is issued. Ensure that these norms are followed as a minimum provisioning requirement. Banks may also add higher provisioning required depending upon the recovery risk. Ensure that bank made adequate provision for bad debts before paying any dividend. And central stat auditors, branch auditors have to verify applicability of prudential norms on asset classification, income recognition and provisioning. Are you clear? Prudential norms means what? Income recognition norm, asset classification norm and provisioning norms. All these three were collectively called as what? Prudential norms, which is as per Basel III framework. Understood? Next, classification of provision. Automated system. In banks, no system is automated for identifying and classifying advances without any manual intervention. These advance classification is appropriate or not, check out, especially where there is a recovery threat. Ensure secured and unsecured portion of advances are clearly separated and provision is calculated correctly. Secured, unsecured portion, that classification is important for doubtful category. For doubtful category, unsecured portion, 100% provision we create. For secured portion, we create D1, D2, D3, 20, 40, like that, some 30, 40, 100, like that, some limits will be there. Then compare date of NPA mentioned in the current year statement with the previous year statements. When the customer account became NPA as per last year bank statement, last year loan statement, current year loan statement also say, in that also date of NPA declaration, you see if at all there is a change, why there is a change. Okay, next, accounts regularized near balance sheet date. What do you mean by accounts regularized near balance sheet? This is a very rare process. Okay, but still, banks are most concerned about NPA position on 31st March. So what bank managers do, sometimes what's little higher level authority, what they do, they call customer, dear customer, I'll do one thing, I'll give you fresh loan. You repay you pay the loan amount first, or else you try to bring funds somewhere, pay the money before 31st March. The account became regular. Then immediately on 5th April, I will give an approval where he can withdraw. Therefore, on 31st March, NPA will be removed. Yes or no? So, if at all where any accounts regularized near the balance sheet date, yes or no, that indicates inherent threat, that indicates inherent weakness. Verify whether an advance is regularized before balance sheet date with genuine source or not, check out. Suppose if further funds were provided after regularization, like customer account became NPA originally, later it became a regular, later again bank gave back the fund. Yes or no? Now, that indicates inherent weakness in the account. Bank has to provide some evidence about regularization to eliminate doubts. So bank has to show me proof that throughout the year it was NPA, but on 31st March it became a regular account. How does it become a regular account on 31st March? Show me a proof that it is a genuine source. Customer paid money out of genuine source. And ensure accounts are classified as per position on the balance sheet date. NPA shall be recognized based on past due overdue concept, not just based on balance sheet date. The concept highlights that not only balance sheet date, based on past account to movement, NPA classification has to be made. Suppose if a customer account, even though regular, appearing regular on 31st March, if at all the customer account reflects inherent weakness, the auditor has to recommend the bank. The auditor has to make sure the bank classifies such loan account still as an NPA. Clear? Then drawing power calculation, I already told. Drawing power is calculated as per bank credit policy and is also based on sanction letter. Ensure proper reporting for creditors and stocks covered under letter of credit and guarantees, because any stock under letter of credit and guarantee means outstanding stock, and creditors, this must be eliminated from total stock value. And ensure net value of debtors is correctly calculated when book debts are also used as security. It should be ensured that drawing power is calculated net of margin. Yes or no? Review stock audit and book debt audit for advances exceeding stipulated limit. And that's it. Special focus must be given for comments made by statutory branch auditor. Statutory auditor. See, in the entire bank audit chapter, statutory auditor means branch auditor. Statutory central auditor means principal auditor. That's it. Next, accounts with temporary deficiencies. What do you mean by accounts with temporary? Ensure temporary deficiencies does not classify as an NPA. Ensure stock statements used for calculating DP is not less than 3 months old. The outstanding in the account shall be treated as irregular. Irregular means NPA. If drawing power is calculated based on old stock statement, we need to file a quarterly stock statement with the bank. If at all for a particular quarter customer did not file a stock statement, that customer account might become NPA. Review of limits. Sometimes no regular limit means regular OD cash credit limit. Some customers no bank will give ad hoc limit, 20% extra margin I'll give, you can withdraw. For example, in COVID time, ad hoc limits were given for many big companies and all. Okay, and these limits, no, they must be reviewed within 180 days of from due dates. Accounts with unreviewed limits for more than 180 days should be considered as NPA. For all working capital loans, no, every 6 months review will happen, whether the customer security is still proper, whether recoverability is there in the customer account, whether proper movement is there in the customer ledger, is repaying interest everything correctly or not. There will be a manual review within for every 180 days. It should happen. If at all a customer account is not reviewed within 180 days, ad hoc limits were sanctioned repeatedly, limits were not reviewed within 180 days, that should be treated as irregular, which means it's an NPA. Clear? So ensure no repetitive or ad hoc or short reviews. Then further, remember, NPA classification is borrower wise, not just facility wise. For example, I gave a housing loan, car loan, credit card to a single customer. Credit card, he defaulted, it became NPA. Automatically car loan, housing loan also I will treat it as NPA even though the customer is paying EMI on time. Okay, because NPA classification is borrower wise but not customer wise. And ensure asset classification is borrower wise and not facility wise. Okay, ensure letter of credit development, invoked guarantees are treated as part of borrower principal account for prudential norm application. Invoked guarantee means what? Guarantees like removed, getting it, invoked guarantees removed, so you will consider it as a liability. Next, government guaranteed advances. These government guaranteed advances are two types: central government guaranteed advance, state government guaranteed advance. State government guarantee you simply ignore. If a customer did not pay for more than 90 days, it's an NPA. You will create a provision, income on that asset will not be recognized on accrual, it will be recognized on cash basis. Suppose if the customer loan is guaranteed by central government and if the customer defaulted for more than 90 days, we will not classify that as NPA because central government guarantee is there. However, interest will be recognized only on cash basis. For income recognition purpose, it is NPA. For asset classification purpose, it is regular. This facility is given only when the loan is guaranteed by central government. That's it. Clear, all of you? Then agricultural advances. Agricultural advances are two types: long duration crop loan, short duration crop loan. Long duration crop or short duration crop, it is decided by crop season, and the crop season is decided by state level bankers committee. If the crop season is more than 12 months, it's a long duration crop. If the crop season is less than 12 months, it's a short duration crop. That's it. And that's it. And for long duration crop, no, if at all the loan is outstanding for more than one season, one crop season, then it's an NPA. A short duration crop loan is treated as NPA if the loan is outstanding for more than 2 crop seasons. That it is there in CA Interbook. Even in the CA Final Bank Audit, they advise to refer once CA Inter Bank Audit chapter. Next. Then provisioning for standard assets. Ensure provisioning for standard assets are in line with RBI circulars. Different sectors will have different provisioning rate. Check standard advances bifurcation for correct provisioning calculation. Restructure. Restructure means what? Customer came for renewal, extension of the credit period, all that. Restructuring, that's it. Okay. Audit steps. Verify compliance with RBI for restructuring. Banks cannot restructure with retrospective effect. Restructuring is only prospective. For example, a customer became NPA, it already came into doubtful, now the customer came for restructuring, still it is classified as doubtful. Because suppose if a customer came for restructuring before default itself, default is not yet made, before default itself he made, sir, next 6 months my cash position is very tight, right now itself I came for restructuring. Now bank will straight away classify that loan as a substandard asset. Okay, once a loan is restructured, it is immediately classified as a substandard asset for 1 year. For 1 year, for 1 year we will see as per restructured terms customer is paying correctly or not. I will see if at all customer is honoring restructured terms and conditions correctly for 1 year, we will again upgrade it to a regular asset. Are you clear? Next, upgradation of accounts. Any of this can be asked as a 3 or 4 marks question. Upgradation. See, upgradation means what? It is an NPA. Now it is becoming a regular asset. See that RBI guidelines are followed for upgradation from NPA to standard. ensure that overdue portion is fully cleared before upgrading. This is most important condition. If a customer did not clear the pending outstanding amount, okay, we will not upgrade it. By the way, pending amount means what? Pending EMIs plus additional interest charged by the bank. That entire amount customer has to pay. Then only the remaining loan will be upgraded into a standard asset. Understood? Also check that there is no possibility of incorrect upgradation based on partial recoveries. You should not upgrade a customer account just based on partial recovery. Whatever full recovery liability is there, you need to recover. There is a possibility of recoveries may be made after cutoff date, but account still be upgraded on balance sheet date. So check out when the recovery date is and when the upgradation date. Upgradation can only be on or after recovery date. It should not be before recovery. Are you clear? Next, sale and purchase of NPA. You know, banks will purchase NPA. The purchasing bank is called as a bad bank. Okay, bad banks. Have you heard of ARC companies, asset reconstruction companies? You know, there are many bad banks. Okay, like a bank is there, they have an NPA whose outstanding amount is, let us assume 10 crore with interest, all that, and the borrower is not at all paying. This bank has an option. They can sell that amount to me. They can sell that entire right. That's nothing but sale of actionable claim. What is it called as? Sale of actionable claim. So a bank can sell their actionable claim to me. I will buy this actionable claim by paying 5 crores. And whatever amount I recover from the customer beyond 5 crores is a profit to me. Are you clear? So ensure that NPA sale or purchase policy is well defined and followed, including valuation procedure and delegation of powers. Ensure sale or purchase of NPA must be made without any recourse. Recourse means what? You cannot return it. You purchased NPA, I can't return it to the other person again. So when a bank is purchasing or selling NPA, it must be sold with ultimate obligation transfer. No recourse option. Further, bank should not purchase the same NPA which originally it sold. When I'm purchasing an NPA, it should be something new loan which I have not sanctioned it. Suppose an ICICI bank want to purchase NPA, okay, that NPA should not be ICICI loan related. Are you getting it? That must be HDFC bank loan related or IDBI bank loan related. Now, in case of sale of NPA, this was also asked many times in exam. You know, how to audit sale of NPA. So in case of sale of NPA, the moment a loan is sold, NPA is sold, that entire customer account must be removed from the bank books of accounts. Further, remember, you can sell an NPA only if the customer amount is there in the books of accounts of a bank for 2 years as NPA. It is not 2 years customer relationship, 2 years as NPA relationship. Understood? A customer account which became NPA and stayed in the books of accounts of the bank for at least 2 years, then only it can be it can be transferred as, then only it can be sold. Indirectly, what are they saying? Only a doubtful asset can be sold. Substandard asset cannot be sold. Simple. Yes or no? Verify sale consideration is paid upfront on cash basis and not on a contingent price. The person who is purchasing this NPA should pay fixed amount at the beginning itself. It should not be linked with collection amount. No, not permitted. And check if at all NPA is sold, no, below book value if at all NPA is sold. Like for example, in my books 10 crore outstanding amount is there, I received only 5 crore. The balance amount is transferred to P&L account, it's a loss. Suppose if I sold above net book value, excess provisioning should not be reversed. It should be used to cover any other NPAs, okay? And the profit will be taken to P&L. Verify bank does not have any legal, operational and any risk related to sold NPA. Once it is sold, all risks are gone to the other person. I will have to straightaway recognize my profit or loss in the P&L account. Clear? Purchase of NPA. Ensure provisioning requirements based on classification of purchased NPA. For example, the other bank, which has NPA, in their books it is D3 asset. When I purchase, in my books also it will appear as a D3 asset only, doubtful category 3. Suppose in the other bank, it is recorded already as a loss asset. In my books also, when I purchase that NPA, I should also record it as loss asset. Verify recoveries from purchased NPAs are accounted correctly. So once I purchase an NPA, I will start recovery from my recovery agents, all that. So whatever I am recovering, I should record it. Suppose I purchased NPA for 5 crore, I recovered 1 crore. That I will adjust it with the purchase amount. First acquisition amount I will adjust. If at all I get more than acquisition amount, I will transfer to P&L as a profit. So first adjustment against acquisition cost. Recovered amount in excess of acquisition recognized as profit. And when you're calculating risk weight, for the purpose of capital requirement adequacy ratio, 100% risk weight will be given for purchased NPA. Understood? Verify capital adequacy is adjusted with 100% risk weight for purchased NPAs from other banks. Clear? See, I'm discussing so intensely because MCQs can come from anywhere. Understood? That's it. Fine. Shall we continue in the next session? So fixed assets and all easy. Fixed asset is easy, very easy. Other assets only bit tough. Then other assets And liabilities we have, once we discuss this, contingent liability discussion is there, concurrent audit discussion is there over this chapter. Okay, so that's it. Okay, in the next session we'll be covering this remaining topic. Comfortable with bank audit? Only 52 minutes, major concepts we covered. So we started discussion of audit of bank. Inside that we already completed various introduction and formalities, as well as we completed audit of assets. Inside that, up to loans and advances we completed. Now we need to discuss about fixed assets. So cash and bank balances, investments, advances, all the three asset type audits we have completed. Now we need to cover about fixed assets. Now, obviously fixed assets are broadly categorized into two categories. One is premises and other fixed assets. So how to do audit of premises? Premises means what meaning they give, other fixed assets means what meaning they give, which is very simple. And evaluation of controls, only controls point they can ask as a 4 marks question. So first look at the expenditure, controls over expenditure on fixed assets, and verify accountability and utilization control. Examine information controls for availability of information about fixed assets, nothing but records maintained regarding fixed assets. Location of documents of title regarding fixed asset documents, ownership documents, where are they kept? Are they kept in a bank, or are they kept in the in a company's head office? Where? Whether fixed asset register is maintained centrally or at branches. Check whether acquisitions and disposals are communicated to head office, and are they as per authorization manuals. Premises, this is something that you can understand on your own. Okay, now before I go further, let's look at once the structure of balance sheet. If you see, we'll directly open bank balance sheet. Suppose annual report SBI 2025. This observation is very important because recently they've asked regarding classification, which we don't have in our syllabus. First of all, minute, loading. Yeah, so this is SBI annual report. You see, almost it is 520 pages, close to. So this is the balance sheet, standalone balance sheet, and this balance sheet. You see the how it was given in the same order in our book also it is discussed. Yes or no? First cash and cash equivalent, cash and cash balances with banks, then investments, then advances. Then we have two more types of assets, that is fixed assets and other assets. In the same order only it is given. Even in the ICO book it is given in the same order. Then liabilities, if you see, first capital discussion, reserves and surplus, then deposits, then borrowings, then other liabilities and provisions. Now if you observe cash balances, okay fine, I think they have given, okay fine, we'll come to that respective category and then discuss. Just what are we discussing now? Yes, cash and cash balances, cash in hand, balances with RBI. Then balances with banks, how it is classified? Balances with bank in current accounts and other deposit account, money at call and short notice with banks and with other institutions, and how much is outside India. Then investments is again classified into government security, other securities, and shares, debentures and bonds, subsidiaries and investments in subsidiaries and joint ventures, and any other investments. Investments outside India, again government securities, subsidiaries, and then others. Again investments in India, investments in outside India, gross value, net value, breakup. Advances, you see, totally we categorize into three parts. See, the same amount, the same total advances we presented in multiple ways. Okay, one way is regarding the type of advance: bill, purchased and discount, cash, credit, OD, loans repayable on demand, all these second category, and term loans. So based on the nature of the loan, based on the nature of advance, three classifications. Based on security or guarantee, three classifications: secured or covered by bank or government guarantee, unsecured. So next, based on like a location where the advances are, advances in India, advances outside India. And if you see in India and outside both, total it 416 again, here also 416. It is just a multiple ways of presentation. And advances in India, priority sector, public sector, banks, others, how much? Priority sector means nothing but agriculture loan, housing loan, MSME loan, or education loan, all this comes under priority sector. Then now coming to fixed assets, in our book it is clearly told fixed asset is broadly divided into premises and other fixed assets, yes or no? So the same is given here exactly. Then coming to other assets, what are all there? Inter-office adjustments, interest accrued will be there, tax paid in advance is there, non-banking assets acquired in satisfaction of claim. This one asked in May 25 exam. Understood? See, in our book, no, they presented clearly. Even in the ICA book also, they presented in the same order, but we don't observe that it's a classification. So in exam they are asking how, debts acquired in satisfaction of claims, amounts acquired in assets acquired in satisfaction of claim, how to present that, where to classify. We don't observe that, but it is given clearly. But they didn't explicitly give any format. They didn't give, so we generally don't pay any observation. Yeah, next up. So audit of other assets, inter-office adjustments. So ensure inter-branch accounts are reconciled at central level. Report on year-end status, indicating dates up to which accounts have been reconciled. Mention number and amount of outstanding entries in debit and credit. Check whether discrepancies are properly dealt in the books. Interest accrued, verify interest is accrued on entire loan, mainly on overdue bills and purchased or discounted. Ensure that only realizable interest is recognized on accounting standard 9 basis. Next up, tax paid in advance, TDS, that one, that's normal. Stationery and stamp, ensure that it only includes exceptional items of expenditure like bulk purchases. Normal routine stationery purchase, printing and stationery, that expenditure we will debit to P&L. Evaluate existence, effectiveness, continuity of controls over these items. Generally banks, big all institutions, they purchase stationery in bulk quantities and they recognize it as an other fixed asset, other assets, and evaluate controls over stationery and stamps and report it in LFAR. Physically verify these stationery and stamp and see whether any shortages are noticed, and ensure that cost of stationery consumed is properly charged to P&L. Then non-banking assets acquired in satisfaction of claim. And regarding this, one important observation is, bank shall not hold immovable property for more than 7 years unless it is for its own use. As an investment, a bank cannot hold for more than 7 years. Or if any asset is acquired, out of satisfaction of debt. For example, I gave a loan to a customer, housing loan, he's not repaying, I acquired back that house. Okay, that I cannot hold, I cannot carry for more than 7 years in my books of account. I have to sell it off. So if I have a building in my books of accounts, it can only be owned by me for 7 years. If at all I'm not using it for my own business, if at all you're using it for your own business, corporate office or branches, some purpose, then you can have it permanently, no problem at all. Next. So non-banking asset. Non-banking asset means what? That's not my asset. Yes or no? It's a customer house I acquired in satisfaction of claim. Like I have a claim on him, like he has to pay me the loan. So I settled with that and acquired the house. I took over the house. Okay. Ensure that non-banking assets are acquired in satisfaction of debt or and intended for disposal. Verify the assets with documentary proofs like settlement term, court order, all that. Check ownership is completely transferred to the bank or not. Ensure that assets are recorded at lower of net book value or net realizable value, because you're holding it for sell. When you're holding it to sell, obviously NRV is most important. Yes or no? Next step. Yes, assess if dispute require liability or provision, whatever, and check compliance with section 9 of the Banking Regulation Act. That's it. The non-interest bearing advances, not an important one. Loans and advances to officials and relatives, not important. Security deposit, not an important one. Prepaid expenses, suspense account, nothing is important. Miscellaneous debit balance in government account. Why I feel important? Because there are more than 4 points. Simple logic. Okay, because in a question in exam they'll ask at least 4 marks or 5 marks question. That is the logic. Okay, so now miscellaneous debit balances on government account. Review aging statements for these statements, because for all government accounts, most of the times banks, not only banks, every person will receive very late from government. So that's why aging analysis is important. Examine recoverability of old outstanding items. Ensure claims for reimbursements that have been made by the branch as per the terms and conditions. To various officers for various purposes, government will have a tie-up with the bank, and the banks will reimburse all the expenses for various purposes. Okay, and bank will debit to the government, concerned government, local authority or state government or central government, they'll debit, and bank has to collect from them. Ensure that net balance of recoverable at head office should also be taken as per aging analysis. Verify provisions are needed due to a lack of confirmation or lack of justification for old outstanding balances. See that provision is made correctly or not. Ensure reasons are recorded correctly and reviewed for major variances compared to previous year. This is also important. Next, then coming to liabilities side of the balance sheet. Now capital and liabilities, I hope you are aware of, bank has to maintain a minimum capital adequacy ratio of 9%, NBFCs has to maintain a 15%. Okay, for NBFCs we have tier 1 minimum 10. Okay, in case of gold lending NBFC, tier 1 is minimum 12. That and all were there in NBFC. For a bank, the capital requirement ratio is 9%. That's it. There is a simple logic. Why for bank is it lower than NBFC? For banks, they already have to maintain statutory liquidity ratios, all that. So since liquidity requirements is very heavy for a bank, so they don't have to worry. Yes or no? See, capital requirement norm is what for all banks and NBFCs. Why minimum capital is required? That is also like a cushion. Okay, that's like a safety margin. Then Basel III framework, 99% they won't ask, but if at all. Okay, purpose of Basel III Accord, to absorb shocks from financial economic stress, improve risk management and governance, enhance transparency and disclosure. You see, entire prudential norms were there, right? Income recognition, asset classification, provisioning norm, all these are because of Basel III framework only. Then what are capital adequacy measures in India? It is governed by statutes with minimum capital requirement. So almost there are laws where they say every entity, especially financial institutions, must maintain minimum capital. So RBI prescribes a uniform approach for all the scheduled banks. Banks must have enough capital to absorb losses, and this capital is divided into two types: tier 1 capital and tier 2 capital. Tier 1 capital is highest quality capital, tier 2 capital is low quality capital. It is less effective in absorbing losses compared to tier 1 capital. Subordinate debt, all that comes under tier 2 capital. Indian banks and foreign banks operating in India have separate guidelines with respect to tier 1 composition, tier 2 composition. Detailed guidelines are provided by RBI on how to calculate risk weighted assets and off balance sheet items for capital requirement adequacy ratio. CRAR means capital requirement adequacy ratio. And audit process: verify RBI guidelines are followed for capital adequacy with minimum requirements. Ensure bank maintains required CRAR, that is at least 9% on ongoing basis for banks. Review classification of capital into tiers as per characteristics and quality of the instrument. How to calculate capital requirement ratio? Eligible capital funds divided by risk weighted assets into 100. Simple. How much is the risk weighted asset? How much is the eligible capital maintained by the bank? Multiplied by 100. So for example, capital maintained by the bank is 100 crore, risk weighted asset is 1000 crore, into 100 is equal to 10% they are maintaining. Eligible capital funds means what? Tier 1 plus tier 2. This is the same formula which we apply in NBFC also. Understood? Then reserves and surplus. Sometimes they can ask you disclosure requirements also, the descriptive question or an MCQ. So how reserves and surplus has to be disclosed? 5 parts: statutory reserve, capital reserve, share premium, revenue and other reserves including investment fluctuation reserve, balances in profit and loss account. These are the 5 components of the reserves and surplus. So what is a brief audit procedure for reserves and surplus? Verify opening balance of reserves by comparing with previous year balance sheet. Check what is the movement in the reserves and surplus account, additions and deletions, and are they properly documented. Verify legal compliance for statutory reserves utilization and share premium. Verify that prescribed percentage of profit is transferred to reserve fund as per the norms. Check for exemption from transfers. Review documents granting such exemption. If at all there is a compulsory transfer requirement, but there is an exemption from RBI for that, check exemption guidelines. Ensure appropriation from share premium account comply with Companies Act requirement. Share premium can be used only for certain purposes. Verify compliance with foreign laws with respect to overseas branches regarding any reserves maintained by the foreign branch in overseas countries. Understood? Then deposits. Deposits, we know time deposits and demand deposits. 2 types of deposits. Now current and savings deposit. Verify that accounts opened during the year, and check KYC compliance on a sample basis, whether KYC requirements are complied or not. This is very important. KYC requirement is very important. Ensure savings accounts are open for individuals, HUF and approved institutions only. Savings account is not permitted for company. Savings account is not permitted for a partnership firm, LLPs, all this. Okay, only for individual and HUF, which are personal in nature. Only for them the savings account concept is permitted. Verify balances and check interest calculation and see that there is no interest paid on current accounts. And ensure balance confirmation procedure followed consistently on a sample basis. And ensure debit balances in current account are shown under advances, not netted out as liability. Most important. Suppose there is one question in CA Interbook in the recent case study. What is, like a bank accidentally paid extra amount. Okay, accidentally gave money to a customer where the customer account balance turned debit. Generally customer account balance shows credit balance. Means the bank has to pay. Deposit account shows generally credit balance. By mistake, bank has debited huge amount of interest, which is more than his outstanding amount, his eligible amount, and he withdrawn also. For example, that's treated as a loan. Excess balance in a customer deposit account, by mistake, if at all bank has transferred any extra amount, and if customer already withdrawn it, okay, the debit balance will be treated as what? Loan, advance. It should be shown under advance. MCQ, it is important. Next, and remember, once it is shown as an advance, automatically NPA norm is applicable. If at all it is overdue for more than 90 days, it is treated as substandard asset, and all provisioning norms and all will be equally applicable. Recently, just 2 days ago, Kotak Mahindra Bank, some issue happened. So some big amount has been debited, and of course the bank immediately freezed it. Ensure compliance with RBI guidelines on treatment of accounts which are inoperative, non-operative, dormant accounts. Check inoperative accounts for revival authorization, especially in case where significant reduction in balance compared to previous year. Suddenly there is a huge operations in the last year, this year the account become non-operative. So whether the bank has restored correctly by following RBI guidelines or not, these non-operative accounts and all indicates money laundering activities, all that. Next up. Term deposits. Ensure deposit receipts and cash certificate, TD not required, not that much. General deposits compliance. General deposits compliance. Ensure deposit are not inflated for balance sheet presentation. Most of the banks, I don't know, they'll ask customers, sir, please keep balance on the month end. Because for them, for a better reporting, if deposits are high, their lending capacity will be high. Understood? So for that reason, qualify in the main report in case indication of window dressing. Verify that interest accrued but not due is shown under other liabilities and provisions, not under deposits. Correct, obviously. Interest accrued but not due. So that should be shown under other liabilities and provisions. Ensure framework on KYC and anti-money laundering are formulated and put in place. Next, borrowings. Banks also borrow money. So no, one of the borrowing is money at call and short notice. I will lend it money at call and short notice. I will also borrow on money at call and short notice. So audit of borrowings. Borrowings are broadly classified like borrowings in India from RBI, from others, and from other institutions and agencies, and borrowings outside India. Now, generally what I verify for borrowings, I will verify confirmation certificates. I will verify supporting documents like borrowing agreements, correspondence, all that. Use external confirmation received directly for reliable audit evidence. Ensure a clear distinction is made between rediscount and refinancing for proper disclosure. Verify that borrowings at call and short notice are properly authorized. And we know loan given on money at call and short notice, loan taken on money at call and short notice should not be netted off. It should be shown separately because the parties are different, their parties are different. And ensure that branch has head office authorization for borrowings and the terms of borrowings are as per the head office authorization. Verify that amounts shown under branch accounts are properly classified based on security. Then other liabilities and provision, bills payable. Evaluate controls over bills payable. Ensure draft, mail transfer, traveler checks on standard form. Unused forms are kept under responsible parties custody. Verify reliable private code for coding or decoding. Ensure signatures on DDs are checked with signature book. Nothing but only authorized person should sign the DD. Confirm immediately telegraphic transfer DDs issued by the branch by and advise to concerning branches. Sample of outstanding bills payable you take. Check relevant register, investigate old outstanding debits paid without advice, ascertain the reasons for the same. That's it. Then contingent liabilities. In one of the exam in 22, this main question, how do you ensure all contingent liabilities are identified and properly valued? How do you ensure that? This question was asked. Okay. Obtain representation. You know, they'll ask you, they'll design a case study like the auditor is verifying contingent liabilities, is concerned about banks contingent liabilities because banks contingent liabilities will be multiple and he want to ensure that whether all contingent liabilities are present or not. In this regard, what procedure you will suggest him? Very simple. Auditor has to obtain management representation. What procedure? Auditor has to obtain management representation. You know, whether all, you need to get a representation from management that they need to represent all off-balance sheet transactions have been properly accounted as and when they occurred. Off-balance sheet transactions are supported by underlying documents. Year-end contingent liabilities have been correctly disclosed. No crystallized liabilities requiring provision are included in contingent. A real liability should not be included in contingent liability. Estimate amount of financial impact of contingent liability which is based on best estimates as per AS 29. Review guarantees issued on behalf of bank directors for legal compliance. Ensure management justifies non-disclosure of remote contingent liabilities. If at all any contingent liability classified as a remote, no need to disclose. Look at the reasons and are they justified or not. And in case of letter of credit for import of goods, verify payment to overseas suppliers is based on shipping documents only and are in conformity with the terms of letter of credit. This was asked in MCQ. So payment to importer and payment to the exporter based on letter of credit we do, right? We only when shipping is done. So we don't just pay based on any bill raised by him, bill of lading, like that one question is there in MCQ. Okay, the bank made a payment based on bill of lading. No, Shipping document is the proof. Bill of lading means nothing but when goods are loaded onto the ship, that bill will be given. No, that is called bill of lading. That is not. Shipping document is important for us. Okay. So in case of letter of credit for import of goods, verify payment to overseas supplier who is an exporter is purely based on shipping documents, and they must be in conformity with the terms in the letter of credit. And verify internal controls to ensure that contingent liabilities are properly identified. Review year-end contingent liabilities for accuracy based on prior period. Examine comfort letters issued by banks. Comfort letter is also nothing but similar to LOC. Similar to LOC. Comfort letters, no. Some companies, no, they want to give a some companies, no, when they want to get some big contract, the other person will have a doubts on the financial capability of this company. So the other person want not a guarantee, but I want a proof that you are financially fit. Bank will give a letter of comfort. Letter of comfort shows, okay, that for the other party, letter of comfort given by the bank shows, don't worry, you can deal with this person, he is financially stable. That's it. It's not a guarantee. Letter of comfort is not a guarantee. And verify whether bank has extended non-funded facility, ad hoc facility to other than its regular constituents. Nothing but other than regular customer. If at all bank is given ad hoc credit or non-funded guarantees to somebody, check out. In such a case, ensure concurrence from existing bankers on customer's financial position. And this is what we need to get representation. Now these contingent liabilities are broadly classified into claims against bank not acknowledged as debt, outstanding forward exchange contracts, guarantees given on behalf of constituents, nothing but our customers, acceptances, endorsements and other obligation, other items that is contingently liable, bills for collection. These are all various classification of contingent liabilities. All these are contingents only. Understood? In exam they may ask you, write about classification of contingent liability. You need to write only headings. Okay, that's it. This matter you read later. Okay. Then audit report. The auditor should state the following in the report to the central government. So auditor has to give opinion on these matters. Especially this is applicable for all nationalized banks. Whether in his opinion, balance sheet is full and fair, containing all necessary particulars and properly drawn up to exhibit true and fair view of the affairs of the entity. Then in case the auditor has called for any explanation, whether it has been given, whether or not transactions of the bank have been within the powers of the bank, then whether or not the returns received from offices and branches of the bank have been found adequate, whether the profit and loss account shows a true balance of P&L, nothing but balance sheet P&L are the true and fair, whether transactions of the banks are within the powers of the bank, like that. Then whether returns received from offices and branches have been adequate, nothing but summary. Returns from branches means generally certain branches we don't visit, so regarding those branches we will get a summary, that's called return. So whether those returns are adequate. Then format of audit report, the same 700 series we follow, and we must include a disclosure on unaudited branches such as advances, deposits, interest income, all that we should clearly disclose unaudited branches. For example, you see State Bank of India, I think audit report is given here itself. No. So it will be given somewhere at the last they'll give. So lengthy, financial statements. All these are financial reporting disclosures only. You study financial reporting, that only. After you learned financial reporting, you must be able to read a company and entire notes to account, and you should be able to understand that. Not the meaning, the context. Yeah, this is the auditor's report. And you see here, the auditor has given clearly here an indication. What he has given indication, 19,400 Indian branches were not subject to audit. And these unaudited branches account for 23% of advances, 42% of deposits, 18% of interest income, 34% of interest expenditure on the total income of the bank. Okay, so we need to give such a kind of disclosure. Include disclosure on unaudited branches for advances, deposits, interest income, interest expenditure. Gave or not? Next up, the auditor must report matters covered by 143. CARO is not applicable for a bank. And rule number 11 of Companies Act, disclosures for their right, pending litigations, accounting standard, funding party, intermediary, and dividend declaration, audit trail, that are commonly applicable even for banks. Then, and RBI has given a circular on fraud. So if the internal auditor or external auditor, anybody, concurrent auditor, if at all they come across any fraud or suspecting any fraud, they must immediately report to RBI. So this is a requirement in RBI. And apart from audit report, The statutory auditor shall also give various certificates and reports. What are various certificates and reports? First one, report on IFC. Yes or no? Operating effectiveness, adequacy and operating effectiveness of internal financial controls over financial reporting. So auditor has to give a certificate on this. And of course, LFR, LFAR. And you need to give a report on compliance with SLR, DTL computation as well as SLR maintenance. You need to give a report on treasury operations, and you need to give a report on adverse credit deposit ratio. In one of the MCQ, what they mentioned, credit lending ratio they mentioned. Credit lending, credit itself means lending. Lending ratio, that's wrong. Credit means lending, deposit means this one. So credit deposit ratio, that is most important. Credit deposit ratio shall be always less than 1. Yes or no? Deposit, you have 100 rupees, you can lend only less than 100. You can't lend equal. Yes or no? So credit deposit, if at all lending is more than credit, that's a liquidity issue for the bank. Tomorrow the liquidity issue comes. Next, your auditor has to give a separate report on IRAC compliances, income recognition, asset classification and provisioning norms. Auditor has to give a report on compliance with recommendations of Ghosh committee, Jilani committee for frauds, internal audits, internal controls. Asset liability management, auditor has to give a report on corporate governance, and auditor has to give a certificate on reconciliation of securities and investment accounts and PMS account. PMS means portfolio management services. And auditor has to report serious irregularities which are identified by him under 143.12 fraud. That's it. So then finally the last topic, concurrent audit. Concurrent audit is not concurrent audit is not mandatory. First of all, it is only optional for the banks, and today only nationalized banks have concurrent audit system. Okay, there are many proposals on removal of concurrent audit also very soon, but we don't know when they will do that. So like who can be the concurrent auditor? Who can be the concurrent auditor? First of all, what is the scope of concurrent auditor? It is completely decided by Central Inspection and Audit Department after consulting with Audit Committee of Board of Directors. So the bank's audit committee and internal audit department together will decide whether concurrent audit is mandatory or not. Concurrent audit is different, internal audit is different. Internal audit is another level of audit where they predominantly focus on control. Concurrent audit is predominantly focused on transactions. Concurrent audit's approach is more of substantive. Internal audit's approach is more of compliance. Understood? In a bank. Then high risk transactions has to be compulsorily verified. Random transaction testing for high value transactions wherever required. Detailed scope of concurrent audit will be approved by Audit Committee of Board of Directors. Banks have an audit manual which includes detailed instructions for conducting companies, or this concurrent audit. What is the purpose of concurrent audit? Why? What benefits concurrent audit will give? It's an early warning detection system and timely detection of irregularities, prevents frauds. Banks should review once in a year effectiveness of systems and take steps to rectify any deficiencies. And coverage of coverage in concurrent audit, what areas will be covered? Cash, investments, deposits and advances, similar points only will come. And foreign exchange and housekeeping. Housekeeping means in concurrent audit, internal affairs of a bank. Internal affairs of a bank is called as housekeeping. Whether they are maintaining properly the forms, whether they are doing daily reconciliations of cash balances, whether are they doing daily reconciliations of registers, are they maintaining registers and all correctly. Internal affairs of a bank, all internal control systems of a bank. So that is housekeeping. Okay, next, appointment of concurrent auditor. Bank's discretion, anybody can appoint. Internal staff, banks can appoint internal staff or external auditor, anybody. That's absolutely bank's choice. If at all internal staff is appointed, they must be experienced, well trained and sufficiency involvement. And most important, these concurrent audit staff must be independent of the branch being auditor. Suppose I have to audit so and so Nungamakam branch of Chennai, concurrent audit, I can send some other branch people there. Within the same branch employee, I cannot appoint him as a concurrent auditor. Next, terms and tenure. Audit committee will decide the terms of appointment of external chartered accountant firms. What is the coverage of area? What is required skill set? Number of staff? Time? Everything the audit committee will decide. Remuneration is also decided by audit committee. Audit committee decides the maximum tenure of the external auditor. Maximum tenure is 5 years for a particular bank itself, and that too for a branch it is 3 years only. A single branch you cannot do more than 3 years concurrent audit, and for a single bank as a whole you cannot do concurrent audit for more than 5 years. Mandatory rotation is required. Next, then reporting system, reporting findings, zone wise reporting. These are all reporting systems in concurrent audit. And before you report, obviously you discuss with branch manager. You need to check whether action is taken on irregularity, and you need to see whether any fraudulent transaction, and concurrent auditor has to do follow up because every month he'll be doing. Then finally, what is an audit committee? That's it. Bank audit is over. Okay, predominant tough topics I told. Wherever you generally don't understand, all those topics I covered. Okay, whatever I left is easy topics. Clear? With this, bank audit is over. We spent 1.5 hours on bank audit. Okay, good. So audit of NBFCs, non-banking financial companies. See, here there is a principal business criteria. When an entity is called as an NBFC, if they satisfy principal business criteria, one is asset criteria, two income criteria, both has to be satisfied. If banks financial assets are more than 50% of the total assets, and if the company's financial assets are more than 50% of the total assets, and financial income from financial assets, nothing but, is more than 50% of the total income of such entity, then that entity is deemed to be complying with principal business criteria, and it must register with RBI as an NBFC. So NBFC, their activities, they can't accept demand deposits. That's it. What is the difference between NBFC and a bank? NBFC cannot accept demand deposits. That's the main requirement. And NBFCs are not protected by deposit credit guarantee institution. That deposit, there's no insurance on for the deposit holders. NBFC can accept public deposits, and NBFCs are broadly two types: deposit taking NBFCs, non-deposit taking NBFCs. Again, recently, they have given something called scale based regulations. In 2021 they came actually, 21-22, that year they came actually, and later it was structurally improvised. Okay, as per these scale based regulations, NBFCs are broadly classified into 4 types: base layer, middle layer, upper layer, top layer. There are 4 classifications of NBFCs: base layer, middle layer, upper layer, and top layer. Now, in order to incorporate an NBFC, see, the moment you fulfill the principal business criteria, you cannot run that activity without a registration. And in order to register, you must have a minimum net owned funds of 10 crore. Now the latest rule is, if at all you want to newly incorporate an NBFC, 10 crore. The minimum required capital, net owned funds. The minimum net owned funds required is 10 crore. Further, there are certain NBFCs like peer-to-peer NBFC, account aggregator, or NBFCs where they do not have access to public funds, or where they do not have a customer interface. In all these NBFCs, 2 crore net owned fund requirement is sufficient. Whereas NBFCs, infrastructure NBFCs, okay, IDF, infrastructure debt fund, infrastructure finance, nothing but infrastructure lending related NBFCs, they must have a minimum net owned funds of 300 crore. And existing NBFCs were there. Remember, this 10 crore guidelines were given in the recent past, very just 1.5 years back, 2023-24, that time only it came. Now what about existing NBFCs who cannot comply with the 10 crore? For them, gliding path is given. Okay, by 31st March 2025, increase it to 5 crore. By 31st March 2027, increase it to 7 crore. Like that, something is there. Okay, 2025 it is some 7 crore. By 2025 31st March they need to increase it to 7 crore. Then by 31st March 2027 they need to increase it to 10 crore. Here it is given, you see. Here we have given. So for ICC investment and credit company, microfinance institution, and factor, current NOF requirement is 2 crore. By 31st March 2025, they need to increase it to 5 crore. Investment credit company, microfinancial, they need to increase it to 7 crore. Factors also, they need to increase it to 7 crore. Whereas for Northeast regions, it is still 5 crore for microfinance institution. By March 2027, for all NBFCs, they must have to increase their net owned funds to 10 crore. So RBI has given a timeline for them to rectify their net owned fund requirement. For right now, any new NBFCs coming and incorporating 10 crore, except base layer NBFCs, which are peer-to-peer, account aggregator, NBFC which do not have access to public funds or customer interface. Clear? So that's regarding main NBFC thing. This this capital net owned fund requirement related one. And again, NBFCs are again deposit taking NBFCs, non-deposit taking NBFCs. And so what NBFC can engage in, like what are various types of NBFCs depending upon activities they do? ICC, investment credit company, infrastructure finance company, core investment company, non-operative financial loaning company, infrastructure debt company, and microfinance institution, factors, asset finance company, loan company, mortgage guarantee company, asset reconstruction companies, so many. Then exempted, these NBFCs are exempted from registration with RBI because they already been governed by some other regulator, like housing financial institutions, merchant banking companies, stock exchanges, stock brokers and all, because these are all covered, these are all controlled by SEBI, all that. Now remember, many housing financial institutions now are coming under RBI purview. This is not yet updated list. This is there in our book. So from book point of view, this only you cover. Then venture capital funds, who are all covered by SEBI, Nidhi, MCA, insurance companies, IRDA, chit fund, MCA, specified microfinance companies, probably delegation would have been given to MCA, and securitization and reconstruction companies, SEBI will control, mutual benefit companies, core investment companies, alternative investment fund. And remember, core investment company. What is a core investment company? We know to call an entity as an NBFC, minimum 50% of it must be financial assets. Minimum 50% will be financial income. If at all, an NBFCs whose 90% of the assets are represented by investments, whose 90% of the assets are represented by investments, we call it as what? Core investment company. Now, there is a difference between core investment company and non-operating financial holding company. Like where is it? Now here. You see, there is a core investment company, non-operative financial holding company. Non-operative financial holding company, no, this company also invest in other companies only, but as a holding company they will invest. Core investment companies can invest. They may be holding company, they may not be holding company. Understood? Tata Sons is a core investment company. That's not a non-operative financial holding company. Earlier we used to have Aditya Birla head, group holding one company is there. That's a non-operative financial holding company. Next up. Now, regarding core investment company is a type of NBFC. It must register with RBI as an NBFC. But there are two core investment companies which are exempted completely. One, a core investment company whose asset size is less than 100 crore, straight away exempted. A core investment company whose asset size is less than 100 crore, it's straight away exempt. And a core investment company whose asset size is more than 100 crore and not accessing public funds, then they are exempted from registration. Suppose if you are a big core investment company, more than 100 crore you have asset size, but you don't have any public funds at all. It's a private sector, completely private limited moreover. Understood? For example, if it is not having any access to public funds, then that is also exempted. So which means a core investment company which is having access to which do not have access to public funds is straight away exempted, or a core investment company which has access to public funds but less than asset size 100 crore, that is also exempted. Next. And remember, this is called as less than 100 crore, no? This is called as non-systematically important NBFCs. Core investment companies less than 100 crore is called as non-systematically important core investment company. A core investment company which is having asset size more than 100 crore is called as systematically important. For remaining all other NBFCs, systematically important criteria is 500 crore. For remaining all other NBFCs, systematically important, the criteria is 500 crore. So NBFC, non-systematically important means the asset size is less than 500 crore. NBFC, systematically important means the asset size is more than 500 crore. I'll tell you why this point has a relevance later. Okay. Now layers. Now recently, based on scale-based regulation, based on scale of activity, the RBI divided NBFCs into multiple parts: base layer, middle layer, top layer, upper layer. Upper layer is empty right now. Nothing is there. Okay. Top layer, top 10 NBFCs will come by default in the top layer. Top 10 NBFCs by asset size. Okay, top 10 NBFCs by asset size. You can find a big list of NBFCs that are registered with RBI. Some approximately less than, some we have seen that number 1000 or less than, some less than 10,000, some number is there. Okay, very huge number of NBFCs were there in India. Okay, so top 10 NBFCs, we used to see that list in our class. Okay, fine. So base layer, middle layer, upper layer, top layer, upper layer and top layer. Base, middle, upper, top layer is ideally empty. RBI will populate from upper layer to top layer based upon the risk. Upper layer, by default, top 10 NBFCs will come in the upper layer. Then middle layer, base layer is the question ultimately. And remember, government-owned NBFCs are by default either base layer or middle layer. Until notified, they will never form part of upper layer. Even though a government-owned NBFC comes in the top 10 in the asset size, they still be classified as middle layer or base layer. Clear? Now this NBFC base layer. So NBFCs which are having asset size below 1000 crore, they will be straight away classified as what? Base layer. Now further, NBFCs engaged in these activities, they will always come under base layer. See, one is monetary requirement. If the NBFC amount is less than 1000 crore, it automatically comes under base layer. Sir, I am an NBFC, I have an asset size more than 1000 crore, but I am involving in peer-to-peer lending, account aggregator, non-operative financial loaning company, or I am an NBFC which do not have access to public funds and customer interface. What about me? You will also come under base layer. For them, asset size is not required. Asset size is irrelevant. These 4 NBFCs straight away fall under base layer category. Clear? Then coming to middle layer, these 5 NBFCs will always come under middle layer. What are they? SPDs, standalone primary dealers, IDFs, core investment company, housing finance companies, infrastructure finance companies. This is where the conflict will come. In one of the exempted category, HFIs are exempted, right? Housing finance insurance is exempted, right? But then why housing finance companies are covered under middle layer? One common doubt. Understood? That's why I told that exemption list is not updated clearly. Okay, so housing finance companies are regulated by RBI now. Okay, so fine. So SBDs, these all 5 NBFCs always come under middle layer, irrespective of asset size. They may have an asset size less than 1000 crore, doesn't matter. They will come under middle layer. And what all other NBFCs come in middle layer? Deposit taking NBFCs will come under middle layer, and non-deposit taking NBFCs with asset size 1000 crore and above will also come under middle layer. So 3 categories of NBFCs come under middle layer. Deposit taking, straight away middle layer. Asset size doesn't matter. Non-deposit taking, then asset size matters. More than 1000 crore come under middle layer. These 5 NBFCs automatically come under middle layer. So SPDs, infrastructure debt for non-operative financial holding company, housing finance company, infrastructure finance company. All infrastructure companies were there. Non-operative financial holding company is there. Standalone primary dealers were there. Then peer-to-peer account aggregator. Peer-to-peer account peer-to-peer account aggregator, non-operative financial holding company, and NBFC is not having access to public funds. That will come under base layer. Here, IDF, core investment company. You see, I told non-operative financial holding company, core investment company, both of them, they do investing only. But non-operative comes under base layer, core investment comes under middle layer. Be careful. Next, upper layer. You know, top 10 NBFCs by asset size will always be in this layer, regardless of any other factor. And top layer, ideally empty, will be populated by RBI if there is an increase of, if there is a substantial increase in systematic risk. RBI will categorize and some NBFCs into top layer. Top layer means direct monitoring by RBI every day. Next, categorization of NBFCs carrying out specific activity. The same thing is repeated here. Then what about other NBFCs? The following NBFCs, no, like ICC, MFI, Factor, mortgage guarantee companies, all these companies will be classified according to the base layer, upper layer, base layer, middle layer, according to the conditions which they satisfy. They may come under yet any layer. If these NBFCs asset size is less than 1000 crore, they come in base layer. If these NBFCs asset size is more than 1000 crore, then they come in middle layer. That's it. Now, government owned NBFCs always in base layer or middle layer. Okay, this will never be coming in upper layer until further notice is given by RBI. Now, NBFCs deposit taking, non-deposit systematically important. Earlier, no, NBFCs we used to classify them as NBFC deposit taking, non-deposit taking. Non-deposit taking is again classified as systematically important, non-systematically important. Now, how they are referring, you know, NBFC non-deposit taking will be referred to as base layer. NBFC deposit taking and systematically important, they will be referred as either middle layer or upper layer depending upon the applicable classification. Now you see here this create a confusion. NBFC non-deposit systematically important, you are straight away saying it as middle layer or upper layer. Systematically important means if more than 500 crore is that is sufficient. NBFCs which is having more than 500 crore, that is sufficient to call it as a systematically important. Now if you are saying systematically important under middle layer says 1000 crore. Systematically important criteria 500 crore. That's why they give a clarification. Existing NBFCs which are non-deposit and systematically important, where asset size is between 500 crore and 1000 crore, yes or no, they will still come under base layer. So they gave a clarification like this. Clear? All of you? Next, and difference between NBFC and bank you can understand. Prudential norms. Capital ratio for NBFCs. NBFCs must maintain a minimum capital ratio of 15% of the aggregate of risk-weighted assets, which we call it as RWA, risk-weighted assets. And in this risk-weighted assets, 10% of RWA must be Tier 1 capital, whereas NBFCs, which are lending predominantly against gold jewelry, minimum Tier 1 capital must be 12% of RWA. Are you clear? Now, what Tier 1 capital can include? Own funds will be included, perpetual debt instruments will be included. Okay. Now, again, NBFC base layer, perpetual debt we will not at all consider in Tier 1. For remaining NBFCs, perpetual debt can be included. If at all perpetual debt is included for remaining NBFC, that perpetual debt portion cannot exceed. That perpetual debt portion cannot exceed 15% of the aggregate of the Tier 1 capital. Suppose if at all perpetual debt is beyond 15%, up to 15% of Tier 1 capital, we will up to 15% of last year's Tier 1 capital. In the current year, we will add it to Tier 1. If I have excess amount, I will classify into Tier 2 capital. Understood? Now, own funds means what? Own funds means total own funds reduced by investment in other NBFCs and related group companies in excess of 10% of the own funds. In the recent May 25 also a problematic question is given on this. Even in the November 24 a problem question is there. In the past 2 attempts there is a question on this. Then Tier 2 capital, preference shares which are non-convertible, revaluation reserve discounted at 55%. Discounted means what? For example, 100 is there, discounted at 55 means only 45 you should consider. Only 45 you should consider. Originally in the number in the ICA book or somewhere there is a mistake in the problem. Okay, later in the MTP there was a mistake, later it was rectified. Okay, next up, general provision and loss reserves. maximum 1.25% of risk weighted assets. Hybrid capital instrument, subordinate debt, excess perpetual debt instrument. Excess perpetual debt means what? Up to 15% of tier 1 of the last year closing. Yes or no? That will come under tier 1. Excess perpetual debt will come under tier 2. Then, and remember, total tier 2 capital cannot exceed tier 1. Forget about it. Tier 2 capital is substantially lesser than tier 1. Yes or no? Tier 1 will be 10, 2/3 of total 15. Yes or no? In case of gold lending, it is 12 out of 15, almost 80%. NBFC's base layer cannot include perpetual debt in tier 2. Very simple. If at all you are a base layer NBFC, perpetual debt is not at all considered as part of capital. Are you clear? Now, total capital, tier 1 plus tier 2 computed. Then you will get total capital divided by risk weighted assets multiplied by 100. You will get ratio. And that ratio must be 15% as a whole. Clear? Next, risk weighted assets, that's not important. In exam, they'll give you directly. Asset categorization. Asset categorization. Standard assets are those assets where there is no default in repayment of principal, nothing, no default at all. Substandard means what? An asset classified as NPA. I will discuss non-performing asset definition, then I'll go for asset classification. NPA. When an NBFC related asset will be treated as an NPA, if there is an overdue for more than 180 days, there are various types of advances, various types of incomes which will be treated as NPA because they were overdue for more than 180 days. And the period of more than 180 days shall be adjusted as per the gliding path. Now, for your exams, March 31, 2025, this is important. Okay, very simple. Whenever you're writing an exam, what is the latest completed year? You should check. Right now, what is the latest completed year? 31st March 2025. So that limit only is applicable for you. Okay, if you're writing May 2025 exam, March 2026 is relevant. Very simple. If you're writing Jan 2026, March 25 is relevant. Last 31st March is when? Before your exam date, last 31st March. That is only applicable for audit, for income tax, everything you see. Yes or no? If for May 2025 income tax paper or DT paper is based on assessment year 25-26, which is previous year 24-25. Same logic. Now, so for us right now, if at all an MCQ comes, what is the capital, what is the, NPA norm? What is the NPA norm? You can directly say that it is 120 days. Whereas by next year, it must be reduced to 90 days. Like there are existing some NBFCs which are already following 90 days. Earlier, no. All systematically important NBFCs, deposit taking NBFCs, 90 days is only norm. Only for non-systematically important NBFCs, 180 days norm is there. Right now, base layer, middle layer, upper layer. Simply speaking, middle layer NBFC, upper layer NBFC, by default 90 days norm. Base layer NBFC is only 180 days norm is applicable. Are you clear? And any NBFC which is already following 90 days because systematically important criteria. Yes or no? For them, they should not again go back with this gliding path. They just have to continue using 90 days norm. And if you see here, capital gliding path, if you see 23, 25, 27. The years 31st March 2023, 31st March 2025, 31st March 2027. Whereas here you see 24, 25, 26. 1 year gap exactly. Okay. For net owned funds, gliding path is 2 years gap. Whereas for NPA norm, gliding path is 1 year because NPA norm is more severe than capital. Okay, next, provisioning requirement. Now, NPA you understood. I hope now you understood regarding NPA classification. Once you classify as an NPA, straight away, the moment it became an NPA, it goes into substandard category. It goes into substandard category. How long in a substandard category an asset can continue? In case of base layer, up to 18 months it can continue in substandard category. Up to 18 months it can continue in substandard category. And in case of middle layer NBFCs and above, up to 12 months. An asset whose terms have been renegotiated, rescheduled or restructured until 1 year of satisfactory performance, they all come under again substandard category. And remember, if at all you are doing restructuring of a doubtful advance, then it's doubtful only. If at all an asset is already classified as doubtful, that time a customer came for restructuring, then we restructured it, then it's a doubtful. Suppose a customer where NPA not yet came, it has not yet become NPA. Now itself a customer came for restructuring, then I will classify into substandard. Doubtful. Doubtful means what? Suppose if an asset is remaining in substandard for more than 18 months, up to 18 months substandard. The moment it crossed 18 months after it became NPA, doubtful category. And loss asset. Once in doubtful category, D1, D2, D3 levels will be there. After that, banker may classify based on internal auditor's recommendation, concurrent audit recommendation, stat audit recommendation or RBI recommendation. Based on something, they will classify the loan into a loss asset. Loss asset means either they will provide 100% provision or they will write it off the customer account. Next. And that's it. So with this NPA, classification is completed. Now provision for loss assets, 100% of the outstanding amount must be provided for, if at all asset is allowed to remain in the book. You don't want to keep the asset in the balance sheet, straight away write off. Then doubtful asset, 100% provision on the unsecured portion. If at all there is a security and secured portion is there of some advance, then up to 1 year 20% provision, D1 category. Once it comes under doubtful category, after 18 months or after 12 months in case of middle layer, okay, and first 1 year 20% provision, then we need to increase it to 30%, sorry, then we need to add 30%, then we need to add 50%. Are you clear? Yeah, it's add only, actually it's add only. Yeah, totally no, it's totally 100. It will become 100. So by the time of D3 comes, it will become 100. Next, substandard asset, 10% provision of the total outstanding amount must be made. Standard asset provisioning, NBFC base layer must provide 0.25%. For base layer NBFCs, no, the provision requirement is 0.25. Even standard asset also, there is no NPA. Still we create a provision prudence concept, 0.25. For middle layer NBFC, 0.4%. What about upper layer? Differential rates. For upper layer, we don't have in the syllabus, but in RBI guidelines, for upper layer, differential rates. Housing loan NBFCs, housing loan, standard asset, different rate. Car loan, standard asset, different rate. Education loan, standard asset, different rate. For upper layer NBFCs, differential rate of provisioning is required for standard assets. Since differential rates are there, they didn't put in our syllabus. That's it. Next. Now, what is the audit procedure? First you should ascertain the business of the company, which is a simple matter. You need to evaluate internal control system, which is also a simple thing. Verify registration with RBI and see that the NBFC has a minimum net owned funds of 10 crore. And verify NBFC acceptance of public deposit directions, very important. In this chapter you will be getting so many directions: acceptance of public deposit directions, audit report directions, and scale based regulation compliance directions. Like that set of directions will be there in this particular chapter. Earlier we have non-deposit taking, systematically important deposit taking directions, non-deposit taking, non-systematically important directions, okay, and RBI NBFC acceptance of public deposit directions, RBI separate reporting directions, like that various set of directions were there. Okay, now this is regarding acceptance of public deposit directions, that one. Now if at all an NBFC is accepting public deposits, the auditor has to check the following, most important: ceiling on public deposit and credit rating. So NBFCs, I think this point is common even in company law also. In company law you might have seen in deposit chapter, where a company want to raise money in public deposit, first they need to get a credit rating. Yes or no? Only after getting credit rating, the deposit amount, how much they can raise, will be decided. So ceiling on public deposit based on credit rating, and check public deposits accepted or as per the agreed credit rating. And interest and brokerage calculation must be calculated. Written application must be there. Maintenance of deposit registers must be there, and deposits are paid on time. In case of delay, reasons has to be checked. Investment in approved liquid asset. The moment you are accepting public money, you need to maintain liquid assets. That's what even is there in Nidhi company. 10% liquidity then you maintain, 10% in unencumbered term deposit. Timely filing of returns with RBI for deposits accepted by you. If NBFC does not accept deposit, check whether board resolution is stating so. Suppose that the NBFC is a non-deposit taking NBFC, they need to pass an explicit resolution that we decided not to accept deposits, and ensure board resolution confirming investment in group company shares. And in case of credit rating downgrade, this is most important. This was asked even in exam for 4 marks. Okay, in case of credit rating downgrade or upgrade, ensure that deposits are adjusted within the specified time frame. So whenever there is an upgrade in credit rating, you can accept more deposits. Whenever there is a downgrade, you need to follow certain compliance. Moreover, you see here the format, if downgraded below minimum investment grade. What is below minimum investment grade? That's the lowest rate. That's the entry level credit rating which is required to accept a deposit. Your credit rating falls below the entry level. Then what NBFC has to do? Stop accepting the deposits, stop renewing the deposits. Whatever deposits right now is already there, no, up to maturity, hold it and report to RBI within 15 days what action you are going to take. And no, don't renew without explicit consent of the borrower. Clear? Actually, here we will not at all review. RBI will not permit you to renew. If at all an NBFC credit rating falls below minimum downgrade, minimum credit rating, yes or no, they should not accept deposit. Whatever the accepted deposits they have, they need to repay. Clear? Next, and obviously prudential norms verification. Prudential norms verification means nothing but asset classification, income recognition, and prudential norms. Then classification of frauds. There will be so many frauds that will be happening in many banks, financial institutions, all that. RBI has given a framework for fraud classification. Every NBFC, because in NBFC any fraud happen, they need to report to RBI. Now when they're reporting to RBI, what is the type of the fraud they need to select? What is the type of the fraud? So accordingly, RBI classified types of frauds in NBFC into following categories. What are they? Fraudulent encashment, unauthorized credit facility, negligence and cash shortage, cheating and forgery, irregularities in foreign exchange, other types of frauds. And this requirement is applicable even for foreign branches. And now, negligence and cash shortage. Negligence and cash shortage is treated as fraud only if intention is proved. However, in the following two cases, even if intention is not proved, doesn't matter. Since the amount involved is more than 10,000 rupees, it is always a fraud. So if there is a cash shortage more than 10,000, straight away fraud. Further, if cash shortage is not more than 10,000, it's just beyond 5,000, but cashier has not reported regarding this, then also it is treated as fraud. Are you clear? Then for NBFC, ICC means what? Investment and credit company, which means this company will do investing, this company will give loans. Investment credit company means their activities, they invest and they give loans. They raise capital, they raise deposits, or they raise some funds and then they invest or they give loans. That's why you see initially for until certain points investment related audit, and afterwards here all deposits, advances, loans and advances related points you will find. Understood? Now here one observation, unquoted debentures and bonds. Ensure that unquoted debentures and bonds are not treated as investment but treated as term loans. Suppose if an NBFC ICC purchased unquoted debentures, unquoted bonds of another entity, that is not treated as investment, that is shown as a loan. Are you clear? That's why you see in NPA norm, interest on securities point discovered. Yes or no? Because it is treated as loan. It is treated as loan. Next, just 1 minute. Yeah, next one. So auditor's duty with what? Compliance with RBI auditor's report direction. RBI has reposed something called audit report directions, so auditor has to comply with that. In that, one of the important direction is auditor has to file something called exception report to RBI. Auditor has to file something called exception report. This was asked for 4 marks once. Okay, now like what is an exception report? Exception means what? Unusual things, non-compliances, that's it. Exception means non-compliances. If auditor finds that the company has not complied with provisions of chapter 3B of RBI Act, provisions of chapter 3B is nothing but 45 series, section 45 series. 45 series in RBI Act is nothing but dealing with NBFCs. Okay, or NBFC acceptance of public deposit directions. If auditor find a non-compliance with RBI Act, if auditor finds a non-compliance with acceptance of public deposit directions, if auditor finds a non-compliances with directions, scale-based regulation directions, in all these 3 directions, in all these 3 laws and regulations, nothing but if auditor identified any non-compliances, the auditor must report the details of those non-compliances to RBI regional officer under whose jurisdiction the company is incorporated. Okay, then the audit report should only cover contraventions, and the report need not include regarding compliances. You don't have to talk about compliances, you only have to report exception, not only non-compliances. There will be some form, all that will be there, we don't have to know it. Next, then now there are some specific issues that you need to report in case of an NBFC which is not accepting public deposit. That too, this is a report to board of directors. Here reporting requirement is there, right? RBI reporting directions were there, right? First you should give audit report, that is one common thing. Apart from audit report, you must give a special report to board of directors. Apart from report to directors, you must file a report to RBI. Just know Visa what you need to file with RBI. Now we should give a report to directors, right? Now this report is again subdivided into multiple types. Suppose if an NBFC is not accepting public deposit, if at all they don't have a public deposit, you as an auditor has to give a special report to directors of the NBFC. What you need to report in that? First, whether board resolution is passed or not. An NBFC which is not accepting public deposits, they must have an explicit board resolution every year that they will not accept public deposits, and ensure that the company has not accepted any deposits during the year. And auditor shall also give a report to directors that whether they complied with the prudential norms or not. And further, the auditor has to give a report to director that whether this particular NBFC, whether your NBFC is maintaining capital requirement adequacy ratio correctly or not. Ensure that CRAR disclosed in the return submitted to RBI is correctly calculated and compliant with CRAR norms. and verify that the company has submitted annual statements of capital fund, risk assets exposure, risk ratio, all that within specified time frame. And further, see that whether the NBFC has been correctly classified as a microfinance institution as per master directions of RBI. That's it. These are the specific points which auditor has to check and then report to board of directors. And apart from this, suppose if at all the NBFC that you are auditing is accepting deposits, then the auditor has to make a special report to directors on these matters. First one, whether the public deposits and borrowings like unsecured debentures, all this are within the limits prescribed by NBFC public deposit directions. Check whether excess deposits beyond permitted limits have been regularized. Regularized means what? Beyond my credit rating, I accepted, I need to repay it. Next up, public deposits without credit rating. Verify that NBFC is not accepting deposit without a minimum investment grade. Remember, investment credit rating is there, right? Grading is there, right? That is there for the NBFC, and not only that will be there even for multiple deposit schemes. Suppose if a state bank is there, you go fixed deposits, multiple schemes will be there. For each scheme, credit rating will be there. Understood? Then confirm whether capital adequacy ratio disclosed in the return which is submitted to RBI, is it correct or not? And for NBFCs without minimum investment grade, check whether credit rating for each FD is valid and assigned by approved credit rating agency, whether aggregate deposits have exceeded specified limit of the credit rating at any point of time during the year. This point we need to check for which NBFCs who do not have even minimum investment grade, who actually failed. Technically they are downgraded, technically they need to repay. Yes or no? But they will get credit rating for FDs. Whatever the FD they accepted, rating they will get. Then RBI, auditor has to report to board of directors regarding compliance with prudential norm. Auditor has to report to board of directors regarding NBFC's compliance with liquid asset requirement. Liquid asset requirement will come wherever deposits are there, remember. And auditor has to give a report to directors whether the NBFC is submitting return of deposits on time correctly or not. Auditor has to report to board of directors whether the NBFC is filing quarter returns correctly or not. All that. See, all this information directors are already aware of it, but we need to check and then report to board of directors whether everything is okay or not. Are you clear? Then commonly for all NBFCs, what you need to report, whether certificate of registration is valid, whether certificate of registration, suppose if at all the NBFC is exempted to hold certificate of registration, whether the exemption criteria is fulfilling or not. And certificate from statutory auditor, this itself can be asked as a 4 marks question or 3 marks question. SASE, certificate from statutory auditor. What is this certificate? NBFC must submit a statutory auditor certificate confirming. Remember, this certificate NBFC has to obtain from auditor, and this certificate has to be filed with RBI. So every NBFC should obtain a certificate from stat auditor and file with RBI. What certificate? That the company is engaged in NBFC and the company is eligible to hold certificate of registration, and this certificate must be filed with RBI office within 5 working days of signing of the audit report, but not later than December 31st of the same year. Within 5 days of audit report being signed by the auditor, ask him SAC certificate and file with RBI. Then the format of SAC is prescribed in master directions. So write about statutory audit certificate in the context of NBFC. 3 marks question might come. Clear? That's it. NBFC is over, typically speaking. Then we have CARO related, which we already covered. Okay, I already covered in CARO. Then Ind AS. So NBFCs must comply with Ind AS. Now there is a difference between division 2 and division 3 reporting. What are the differences? You better understand that than me. Okay, that's it. Clear? NBFC is over. Confident? Got entire that overview? Any confusing point in NBFC? All dots connected?